Hey, welcome to Exchange. Let's check out this Peloton news. They changed around their pricing model and really look at how it affects their bottom line as well as their valuation. This is like an article from a few days ago. It's on Peloton. Basically, what they did is they raised their subscription fees while cutting their actual hardware fees for their bikes and the Peloton treads. This is from the new CEO came in. I mean, he's been in the seat for a few months now, so it's relatively newer. But you'll scroll on here and see the changes right now. So, which the big change right now is basically the price of the subscription plan. Basically, their app plan goes from $39 to $44 in the U.S. Canada goes from $49 to $55. But really the big change is going to be the actual price of the actual hardware itself. So the Peloton Bike itself will drop price from $17.45 to $14.45. I mean, these are pretty large decreases in price. And this price also includes $250 shipping and setup fee, which it was put in last year. Bike Plus will drop to $19.95 from $24.95. I mean, think about that. That's almost a 20% price decrease for that, which is a pretty substantial decrease. Peloton Tread, not quite as popular, not quite as heavy volume there, but it's still dropping the price down almost $200 right there. So it's still a heavy decrease right there. And the overall Peloton stock, it's been pretty flat for the past few weeks. There was a big spike we had in early February. It was really the buyout rumors that happened there, but it's really been on a steady decline from the low 30s all the way now down to about $23 or so. Mid-March was hitting around $21 or so. So I mean, it's really been a pretty strong decline. But we're going to see what's going to happen, where it's going to go forward in the next few months and or year plus as they kind of strengthen their business model and hopefully get more subscribers to buy into the Peloton brand. So let's take a look at the valuation real fast. So I put up here's the valuation I did. If you haven't seen the last video, take a look at it. This is the valuation I did back in January, February timeframe. Basically retweaked it for the new pricing model, how things are going to change. Given obviously prices are decreased for the Peloton actual hardware products, which should increase demand, but we'll see. We don't know quite how elastic it is. Maybe Peloton may not even know themselves. Subs probably will drop off too as basically the prices decrease, but I mean, it's not a massive increase to that $44 range. I mean, it's only $5 per month, which you think, average Peloton user at that $5 is not a huge increase overall. But really what you have changing in 2022 really is the hardware versus software breakdown. So in 2021, a 78% hardware clothes and shoes, 21% basically the app itself, the software side. I mean, 2022 is going to be a much higher increase for the software side versus the hardware side, about 70%. Now, this might readjust. That's what this model really shows. It might rebalance a little bit. This might be almost like a shock to the actual system itself, basically post-COVID, as the actual hardware side drops off quite a bit just from natural like forward buying and everything else. But really the thing to notice here is looking at operating margins. What I'm seeing right now for 2021 is 36% operating margins, basically what they reported. What I'm seeing in the future is 23%, 21%, 22%. I mean, this is a whole different business, basically. So what I think is important here to really look at number one is the actual connected fitness products themselves. Look at these margins. So basically the connected fitness products, in 2021, $3.1 billion of revenue at a cost of $2.2 billion in basic cost of revenue. In 2022, look at this projections though, $24.85, so $2.4 billion of revenue versus $24.35, $2.435 billion of cost there. So basically by dropping these hardware costs that low, basically, you're going from a 5, 6, 7% margin plus down to probably a 2% or maybe even 0%. But this is on a gross margin basis. On a net margin basis after promos or after sales and marketing expenses, everything else, it's going to be very, very, very negative. So basically what it's saying there is for every piece of hardware that they sell, whether it's tread or bike, doesn't matter. They're basically probably burning a couple $100 in cash trying to move those things out the door and basically get those new subs to buy in and for that long-term customer lifetime value there, which is going to be, I mean, it's the right play in the short term though, but like long term, if they don't do it right, it could blow up the company if they're not careful. Now, up top, honestly, is fine. The price model shift, business kind of style shift. Really, what now is really the war on operating expenses, the war on OPEX. So look at 2021, $16.39 in OPEX. I'm saying in 2022, $11.66. I mean, they have to drop their OPEX down. If you're near saturation for your market share, if you're trying to, our goal is to have this, niche market. It's basically the cash cow. We can milk them for cash overall by raising the subscription fees higher and higher potentially, or offer new like digital products, etc. I mean, really the problem is now the marketing spend you have now is just way too high for their current business structure. The revenues cannot support this kind of lack of growth on this current sales marketing expenses. So, I mean, this is going to drop. We know in 2022. The question is how fast and how far. But I mean, if they're smart, they'll get very aggressive with these cuts overall. G&A, based general administrative costs there too. I mean, they've cut back employees. I mean, they're scaling way down than they were in 2021. So that should come down quite a bit too. The question is how far. If we're anywhere near this 1639 number in 2022, I mean, it's going to be disastrous for this company going forward because they're just burning too much cash versus the revenue they're bringing in, and also bottom line they're bringing in too. R&D, I'm saying it gets absolutely annihilated, it gets absolutely cut. I think new product launches next 2-3 years might be out the window unless they want to take on massive amounts of debt overall. Look at the bottom line, like net income itself. I mean, it's going to be a pretty ugly 2022 and pretty ugly 2023. I am saying by 2026 timeframe, they should be okay. I mean, there's a chance to save this company around. There's a chance where, hey, they might become a very high-end niche market, drop the actual OPEX expenses down. Where also they're making a lot of money based on the current market share they actually already have, and they just maintain that. I mean, you don't have to become the next Apple or Netflix of the world. If you have a small market share that's highly profitable, that's totally fine too, assuming your OPEX doesn't grow out of control with it. So based on this valuation and kind of this new price model they put in, I really see the value as $12.87. I know right now we're trading about $22, $23. I mean, this is well below, but what you might see is really this value and this dip, this changing pricing model. But my number one thing I'll look for in basically an earnings report, a 10Q or a 10Q or 10K, would be this really OPEX number to come down. I think honestly, the more it comes down, it's the better it is for the company overall too. Because right now, I really see this as like the biggest contributor to kind of their cash flow issues and everything else too. This number has to come down. You cannot play in a smaller market like it is, which it's only 3, 4, 5 million people or so that use Peloton all the time. Which this number does not support that kind of spending overall, unless they raise prices dramatically for their hardware and their app itself, which they're not going to do. Which again is long term probably a smart answer, but short term maybe a short term pain, as you can see in the actual net income right here. But again, let me know your thoughts on this. This is actually a pretty conservative valuation. If this is not correct, if they don't change their OPEX more aggressively to the downside and drop that sales marketing expenses much lower, I mean this could easily be a sub $10, sub $5 stock if they're not careful. Now the upside is long term. If they recover, go through that kind of the valley of despair, the back end could be very profitable. This could be a well under the valuation of what it could be for 2025, 2026. But again, we'll see. This next year for them really is a massive pivot year, and it's going to be trials and tribulations across the board. Hey, but that's Peloton. I mean, let me know your thoughts in the comments down below. If you like the video, obviously the like button down below too. Be sure to sub to the channel overall for all kind of content just like this. And yeah, that's the exchange.